Hello and thank you for checking out today's market update video. This is Jason Wink and today is December 5th. It's just about noon, so the market day is just about halfway over. Revisiting our S&P 500 daily chart just to show everyone the sort of intermediate trend in the stock market, and then I'll also do a quick revisit on a couple other key financial markets as well. This is a chart I've shown quite a few times. So as I mentioned, this is a S&P 500 daily chart. Each bar you see on this chart represents a trading day. So the red bars are the down days and the white bars are the up days. And the two lines that you see that I've drawn in represent the prior long-term, or sort of, I guess it'd be more of an intermediate term, but the uptrend. That's this blue channel on the left. There was a sell-off that happened in May, and then the more recent channel that's been rising and not quite as strong and in a bit wider range is this channel here in red. Again, it's still an upwardly trending market. I'd mentioned a couple times in my last two updates that the S&P was at the top end of this range. It's kept kind of bumping into this range, and generally what happens when you're in a channel is that the market trades in between those two bars. So it's continuing an uptrend, but doesn't mean that it goes up all the time. And we can see kind of in the top right-hand corner that if today ends up finishing down, the market's down about 0.3% right now. And today would be the fifth consecutive day that the S&P 500 has finished down, although each day it's been pretty modest. And this would be exactly what I would have expected. So hopefully if you've watched the past videos where I saw it appear in this top end of this range and said, well, most likely what's going to happen is the market will trend downward at some point. It may go as low as this bottom end of the channel, but as long as it stays in that channel, it is still very much an upwardly trending market. The ways that it breaks out of that is either it breaks out to the upside, so it sets a new trend and goes higher than what this sort of trajectory of the range is, or it can also break out to the downside. But oftentimes, like we saw with the last uptrend, that one lasted about 6 or 7 months. This one's also about 6 months in. It doesn't mean that they're always 6-month channels. It just means that these last two times it happens to be that way. And what we're seeing right now is again a very natural correction. Anybody who's panicking, I guess there's not much reason to panic. This is normal. Markets do go down. Sometimes we forget that when they've been going up so much for the last year or so. And really the point by which action would be taken is if the market broke out to the downside. People might want to consider locking in gains that they've made over the past couple of years. That's the trend that we're in right now, and I don't expect much to change in this. I think that either, again, the market will continue to kind of jostle back and forth. If it does that, it could go down as much as about 4 or 5% before it hit the bottom end of this band. And then it very well could go back up to the top end and continue running in this channel for quite a while. I'm not sure that's what's going to happen, though, and the reason is because of the long-term trends. So I'll show everybody a couple other views of the S&P 500. The first is the S&P 500 looking at it weekly. So what this is looking at is the last 3 years, and each bar you see represents one trading week. And the reason why I bring this up is that we can see at the top, I drew in this blue line, and that represents on the top here, it's called relative strength. And it's a good indicator of if the market's overbought or oversold. Basically, did it go up too much too quickly or down too much too quickly? And when it gets up in this top range, like where this blue bar is, oftentimes the market is due for a correction. It's gone up too much too quickly. And we can see a lot of the times that that's happened. Going back 3 years ago, it happened. The market kind of traded sideways and eventually had about a 15% correction. It's then touched that same sort of area a couple of different times, and each time it's happened in the recent term, so really 3 times, it's been somewhere between a 3 and 5% correction, so nothing really substantial. And we can see that's exactly where we are here. The market got overbought about a week or so ago. It's now starting to correct a bit, and I would anticipate that we'll see a similar at least 3 to 5% correction, though it is very possible it could turn into something bigger, like the 15% we saw a couple of years ago. If we look at an even longer view, so the next chart, this is an S&P 500 monthly chart. And there's a lot of things going on here. I've drawn in some different lines that represent the long-term trend. Whenever a green bar goes into play, that's sort of my indicator that we're in a long-term bull market. And when a red bar kind of goes in, that's more of a representation of a possible correction, so a warning, if you will. So where we are right now, it's not necessarily the warning zone. You can see that we're still in a very strong upward correction when we look at a longer view. This looks at about 14 years worth of history, with each bar representing 1 month. So there's only been, in the last couple of years, a couple of negative months. I mean, really, there's just been 3 negative months in the last almost 2 years before this month, December, which so far is down just slightly. But when we look at what may happen, we can see again up at the top that the market's pretty overbought. And when that happens, even on a long-term basis, we can see that it happened in '07. We can see back here again that happened in 1999. When the market gets overbought and the trend starts to change, there's been a couple of times where that's happened in the last 15 years, and both of the times that it happened, there was a 50% or greater correction. Doesn't mean that always happens, though. If I took this chart even further back, you'd see that the market was overbought and stayed overbought really for about 2.5 years in the late 90s. So it did continue to go up, sort of in spite of itself. As most of us know, it was creating a pretty large bubble that ended up bursting. That same thing happened in 2007, where the market was overbought, and it actually stayed that way until the real correction came into play over a year. And if we look at where we are now, the market first became sort of overbought, if you will, around April or March or April of this year. And so it's very feasible that it could continue to be creating these green peaks up here in the overbought area for another few months or even a couple of years. What we do know is that when it does finally change on a long-term basis, more than likely this very chart that we're looking at here will throw in another one of these red warning bars. And that'll really be the first time that I'll come out on the blog and say, hey, everyone might want to contemplate kind of hunkering down, because it's possible something bigger, something not so pleasant could happen. This type of long-term trend following does create some false warnings. You can see a couple times where it had these red bars come into play that were a little bit early, and it didn't turn out to be anything too scary, and of course a green bar came right back in. So I don't look at it as the be-all, end-all, but it certainly is worth following, because we can see how important, how valuable it would have been to avoid those 50% plus declines. And every time one of these green bars has come into play that represents sort of a long-term bull market, those have turned out to be accurate. You can see I plugged in some of the returns between the green bars and red bars in here. So right now we're in another one of those uptrends. The market's been going up now for about 2 years since the last green bar. And I think that it's very feasible that this could be, again, no real danger of a red bar, another warning coming into play. Certainly not this month or maybe even next month. So that's kind of what's happening in the stock market. In the bond market, this is a 5-year view, again, a weekly chart looking at the aggregate bond index. And we can see it's quite the opposite of the stock market. The long-term uptrend, which was this blue line, was broken back in May of this year. There was about a 5% decline from the absolute peak to the absolute sort of bottom. And the market's been just sort of trading sideways, the bond market that is. And it's certainly not in a long-term uptrend any longer. It's sort of reversing and establishing what may be the start of a long-term downtrend. So we want to be a little extra cautious with bond investments. Unfortunately, there's no magic recipe. If you're a conservative investor, you're going to likely have bonds in your portfolio. And the only two options are to be patient and let some of these ups and downs happen and occur naturally. If bond prices go down, that means that yields or interest rates are going up. So even when a trend like the price is going down, eventually the interest rates are high enough that it more than offsets it. So we don't want to get too panicky, though one option investors have is to look at much shorter durations, very short-term bonds. They won't have as much price fluctuation, but they won't pay as much interest. They just sort of keep the principal a little bit more steady. And that's something that we've been doing a lot with our portfolios. So that's a broad view look at what's happening in the markets, stock and bond. And I think that as we head into the end of the year, unfortunately, there's no real great signs. The bond market doesn't look all that strong. Stock market looks like it may have a couple, 2, 3, 4% correction. A lot of that could change, though. There's a little saying, I guess, called the Santa Claus rally. It has been such a good year that a lot of fund managers and professional investors don't want to have egg on their face come end of year and look like they were in cash or didn't have long positions in place. So some of them will do what they call window dressing, buying different stocks that have had good returns and then kind of push the market high or higher. And holiday sales have been strong. There's been a couple of good economic reports this week. So overwhelmingly, there's no huge, big glaring warning signs that say that December is going to be a horrific month with huge losses. Again, anything is possible. But based on what we're seeing right now, this is exactly what should be expected. Of course, nobody likes to see a decline of a couple, 2 or 3 or 4%. But if we're going to participate in the long-term gains, sometimes you have to endure a little short-term pain. So I hope this has been beneficial for everyone. I'll be back a little bit later this week with our tactical asset allocation update, share with everybody what we're doing from an allocation perspective. In the meantime, have a great rest of the week, and I'll be back in touch real soon.